Listen carefully. Imagine you're standing in a room where the walls look solid, the floor feels steady beneath your feet, and nothing seems amiss. But all around you, subtle cracks are spreading deep into the foundation. You don't hear a loud crash. There's no alarm, just a slow, almost imperceptible fracture that eventually becomes unavoidable. That's exactly where global markets are right now, and most people have absolutely no idea. They are watching price charts for stocks, talking about earnings, and AI breakthroughs. But behind the scenes, something far more consequential is happening. Something that institutions already know, something the headlines are too polite to mention, and something that could change the entire risk profile of equities as we know them. You're not supposed to see this yet. The narrative machines are still talking about bullish economic recovery and AI-led growth, while under the surface, a quiet exit is taking place. Big banks, the very institutions once at the heart of equity market expansion, are reducing their footprint in equities. This isn't a rumor. This isn't an opinion. This isn't day trader noise. This is structural repositioning happening at the institutional level, and it reflects something critical. Risk is rising faster than confidence can keep up. Before I go further, let me make this clear. This is not hype, not panic, and not a sensationalist clickbait narrative. What I'm about to explain is based on observable behavior, documented trends, and the way capital actually moves when sophisticated players shift strategy. If you've ever wondered why the market doesn't make sense, even when earnings are strong and indices are near record highs, this is one of the reasons. On the surface, the stock market appears stable. The S&P 500 and other major indices aren't imploding, and many sectors continue to show gains. Analysts are calling the backdrop constructive for equities, banking on solid earnings growth, rate stability, and optimism about economic expansion in 2026. Yet even these bullish outlooks concede a fragile underlying risk environment, urging diversification and caution. That's the first clue. When top strategists have to temper confidence with warnings about valuation and fragility, it usually means the real story isn't in the headlines. The narrative about valuation bubbles and stretched risk markets is gaining traction from multiple corners of the financial system. Wealth managers and global strategists have pointed out that high valuations, especially in sectors driven by AI and big tech, are masking deeper imbalances that could eventually force a repricing. At its core, this quiet exit from equities by banks is not because bankers have suddenly lost faith in growth. It's because their risk models are telling them something that most retail investors still don't fully grasp. The probability of steep, disorderly market moves has increased significantly. Look at what's happened in practice. Earlier in the year, clients at one major bank pulled capital from equities at the fastest pace seen in weeks, even when the broader market was near cyclical highs and earnings expectations were strong. Collective withdrawals from U.S. stocks involving institutions, hedge funds, and retail combined exceeded $1 billion in a single week, reflecting a shift in behavior that is far more significant than typical profit-taking. When risk managers and institutional strategists act in concert, it means they are responding to stress signals that are not yet visible in the bar charts most investors watch. This isn't just about one bank or 1 week of flows. It echoes a broader theme in the global banking outlook for 2026, where banks face macro headwinds, fragmented consumer sentiment, rising operational costs, and increasing competitive pressure from non-bank entities. These pressures have forced many financial institutions to reconsider how much equity exposure they are comfortable holding, particularly in cyclical sectors where valuations now trade at historically elevated multiples. In this environment, risk management trumps optimism. So why are banks quietly reducing exposure to equities while the market looks calm and prices look lofty? The reason lies in how institutions protect capital when systemic risk perceptions shift. Banks do not announce headline shifts in strategy because that would destabilize markets, trigger regulatory scrutiny, or spark panic among retail investors. Instead, they adjust positions internally, favoring safer allocations such as cash, fixed income, or strategic debt positions where downside is more limited or predictable. This stealth repositioning creates a disconnect between the narrative of confidence broadcast across media and the reality of risk being accumulated underneath. You hear the optimistic story on air, but the institutions are increasingly hedging their bets offline. Contrast the euphoric narrative with what actually happens on balance sheets. When equity exposure rises too high relative to measured risk, banks tighten risk limits, increase capital buffers dedicated to trading books, and reduce directional bets. This is a mechanical response embedded within regulatory frameworks that require banks to de-risk when volatility or dispersion in earnings outcomes increases. It's not conjecture. It's coded into how bank risk committees operate. And right now, those risk committees are signaling caution. The situation today is eerily similar to other periods of market stress where price action did not immediately reflect the underlying adjustment in risk appetites. In those past episodes, what happened first was not a crash. It was a reduction in liquidity, followed by a subtle increase in volatility, then a widening of bid-ask spreads, and finally forced moves once stop losses and technical triggers were hit. History doesn't repeat exactly, but it often rhymes. And this cycle feels like one of those rhymes. Institutions are watching dispersion increase, valuations remain stretched, and macro risk broadening, even as retail sentiment stays bullish. At the core of this institutional shift is something that most casual investors don't measure: the behavior of liquidity, especially in equities. Liquidity is the lifeblood of markets. Without it, markets cannot sustain large orders without dramatic price impact. Banks, the largest market makers, are uniquely positioned to sense when liquidity conditions are changing because they see both sides of the book. When banks start thinning equity positions and reallocating into safer instruments, it essentially means they anticipate that liquidity might not be as reliable going forward. That's a subtle but powerful signal. This dynamic becomes even clearer when we consider market valuations. U.S. equities have seen strong gains over the past year, with financials rallying in tandem with broader markets on the back of lower interest rate expectations and strong corporate earnings. According to recent market data, the S&P 500 Banks Index itself delivered significant returns in 2025, outpacing many other financial sectors and overall stock performance. However, such gains sift capital into growth areas while compressing safety buffers. When valuations are high, banks need to adjust risk, not chase yield. Another layer to this story is how global macro positioning is shaping up as we enter 2026. Major asset managers and macro strategists note that while equities have benefited from strong narratives such as AI, fiscal stimulus, and lower rates, the equilibrium is fragile. Cash flows and pricing insights show complacency in equity positioning, suggesting that sentiment is crowded and one-sided, which in turn increases the risk of reversal once flows change direction. This is precisely the environment in which banks start trimming exposure, not because equities are worthless, but because risk asymmetry has shifted unfavorably. This shift is not uniform across the banking sector. Some banks with strong capital positions and high profitability continue to support equity markets through underwriting, trading facilitation, and client direction. But many institutions, especially those facing slower loan growth, increased compliance and operating costs or strategic realignment goals are reducing direct equity risk. They prefer fee-based income, wealth management services, and other lower volatility sources of revenue that are not directly tied to market direction. This trend is subtle but widespread. Now let's break down what this quiet exit actually looks like in mechanics, because understanding the mechanics is what separates informed investors from passive onlookers. In simple spoken terms, think of bank equity exposure like a pressure valve on a machine. When everything is running smoothly, that valve can remain open, allowing flows to pass through freely. But when pressure builds, whether from valuation, macro uncertainty, regulatory constraint, or liquidity stress, the valve starts to tighten. Banks close that valve slowly at first, reducing directional exposure, trimming positions, and reallocating capital. Retail investors don't notice because these are incremental changes, not headline moves. But those incremental changes add up quickly beneath the surface. In markets, when large institutions reduce equity risk, it creates a subtle decrease in market depth. When fewer large orders are willing to take the other side of trades, spreads widen and volatility increases. Price can still climb, but the underlying support weakens. It's like watching a suspension bridge carry heavier traffic. As internal tension increases and structural support gets taxed, the bridge still stands until it doesn't. This is one of the reasons why equities have been more volatile in micro moves recently. Small dips trigger outsized reactions, not because fundamentals change dramatically, but because structural support, like institutional equity exposure, is thinning. At the same time, hedging activity, such as selling options or increasing credit exposure, can exacerbate directionless markets. And these dynamics are exactly what the risk managers inside banks seek to avoid by reducing outright equity risk. To illustrate further, consider the behavior of large, diversified banks with global footprints. Many of these institutions have publicly noted strategic restructuring in recent years, including selling non-core assets, scaling back proprietary trading, and focusing more on client services and fee-based income. Some banks have even divested certain investment banking units or reallocated capital from equity trading desks to wealth and asset management divisions. These are not random moves. They are calculated shifts toward stability and away from directional market risk. This shift can be compared to a ship slowing its engines, not because it's heading into calm waters, but because radar shows an approaching storm. The ship doesn't just change course, it reconfigures how it carries its load, how it hedges against waves, and how it manages fuel so it doesn't get caught in open water. Bank risk committees are doing something similar, not panicking, but preparing. The critical part to understand is that this reduction in equity exposure does not automatically translate to a market crash. What it does mean, however, is that markets become more vulnerable to shocks that would previously have been absorbed. Without deep institutional support, large buy orders have less counterpart liquidity, meaning price moves can be more abrupt when the crowd shifts sentiment. This brings us to the escalation phase. If the underlying conditions prompting banks to reduce equity exposure continue, such as higher volatility, stretched valuations, geopolitical risk, tightening liquidity conditions, or regulatory changes, then this quiet exit can accelerate into something more noticeable, more disorderly, and more impactful on prices. This is not random. This is intentional risk management. When risk increases, banks often adjust their balance sheet weightings, reduce leverage, increase hedges, and reposition into lower risk assets like cash equivalents or defensive fixed income. This can create a self-fulfilling feedback loop where reduced demand for equities lowers prices, which in turn triggers more risk mitigation. Markets are influenced not just by news, but by these underlying flow dynamics. Yet it would be wrong to say that all risk is negative or that equities are doomed. What it means is that the risk profile has changed. And when risk changes, valuation models need to adapt. Investors who ignore changes in structural risk do so at their own peril. So, what are the risks? The risks here are real, but not certainties. First, policy changes by central banks, such as sudden rate moves, can impact asset allocation models and force banks to adjust positions. Second, macro shocks, such as unexpected inflation data or geopolitical events, can increase flight to quality demand, pushing banks to further de-risk equities. Third, regulatory shifts can tighten capital requirements, making equity exposure less attractive relative to safer assets. All of these are high probability scenarios, not guaranteed outcomes. Markets rarely move in straight lines, and forecasting exact price moves is impossible. Instead, we watch behavior, not narrative, to anticipate where flows are heading. So, what should you watch next? Pay attention to liquidity flows, not just price action. Watch how volatility reacts with no news. That's clue 1. Watch whether institutional net selling increases while retail sentiment remains bullish. That's clue 2. And watch whether credit spreads widen or certain sectors begin to underperform relative to broader indices. That's clue 3. These signals matter far more than daily price quotes because they indicate direction of capital flows, not just price movement. Stay calm. Markets aren't breaking overnight, but beneath the surface, the structure is shifting. If you want to understand risk instead of just watching price, focus on flow, liquidity, and institutional behavior. And if this breakdown helped you see the market more clearly, share it with someone who's still stuck watching just the charts. Stay informed, stay patient, and subscribe for updates as this story unfolds, because what you don't see often matters even more than what you do. What most people misunderstand about banks reducing equity exposure is that it's not a single decision. It's a sequence, a slow tightening of risk tolerance, a quiet recalibration of balance sheets, a gradual withdrawal of liquidity that only becomes visible when something finally snaps. Markets don't collapse when the last buyer leaves. They collapse when the support structure disappears and price suddenly realizes there's nothing underneath it. This is where we need to talk about how markets actually function. not how they're described on television. Equity markets don't move because millions of retail investors click buy or sell. They move because a relatively small number of large institutions decide how much risk they are willing to warehouse at any given time. Banks sit at the center of that system. They are the shock absorbers. They intermediate trades, provide liquidity, hedge exposures, and absorb imbalance. When they pull back, the entire system becomes more fragile. Right now, banks are not screaming, sell everything. They don't need to. Their actions speak for them. They are tightening internal risk limits. They are reducing directional equity exposure. They are reallocating capital toward assets that behave better during volatility spikes. And crucially, they are doing this while prices are still high, not after a crash. That tells you something important. This isn't reaction. It's anticipation. When institutions anticipate instability, they don't wait for confirmation. They move early, quietly, and incrementally. Retail investors tend to do the opposite. They wait for confirmation, headlines, and price movement. By the time the story becomes obvious, the positioning is already done. This is why surface-level price action can be misleading. Markets can remain elevated even as structural risk rises. In fact, they often do. Late cycle markets are famous for looking strongest right before they become unstable. Prices grind higher, volatility compresses, and everyone feels safe. Until something breaks. Now let's talk about leverage, because leverage is the accelerant in this story. Modern equity markets are built on leverage, not just margin accounts, but derivatives, structured products, volatility strategies, and balance sheet leverage embedded throughout the system. When banks reduce equity exposure, they are also indirectly reducing the leverage they are willing to support. That matters because leverage requires liquidity to function smoothly. Without liquidity, leverage becomes dangerous. Think of leverage like pressure building inside a sealed container. As long as the container is strong and flexible, the pressure can be managed. But when the container becomes brittle, when liquidity thins and counterparties pull back, that same pressure becomes destructive. It finds weak points. It forces selling. Banks understand this better than anyone. They see where leverage is concentrated. They see which strategies rely on continuous liquidity. They see which positions depend on calm markets to remain solvent. And when they don't like what they see, they step away. This creates a subtle but powerful dynamic. As banks reduce exposure, liquidity becomes less reliable. As liquidity becomes less reliable, volatility increases. As volatility increases, leveraged positions come under stress. And when leveraged positions are stressed, forced selling begins. Forced selling is not emotional. It's mechanical. It doesn't care about narratives or long-term value. It sells because it has to. This is where many investors get trapped. They assume selling equals panic. But forced selling often happens without panic, at least at first. It starts quietly, triggered by risk limits, margin requirements, or internal models. By the time panic appears, the damage is already underway. And this is why the current environment is dangerous. Not because equities are guaranteed to crash, but because the system is becoming more sensitive to shocks. Let's talk about inventory and supply in equity markets, something people rarely think about. In commodities, inventory is physical. In equities, inventory is liquidity. It's the willingness of institutions to hold risk. When banks hold equities, they are effectively providing inventory to the market. They are saying, we will absorb selling, we will take the other side. When they step back, that inventory disappears. Imagine a warehouse that looks full from the outside, but inside the shelves are empty. That's what a market looks like when prices are high, but institutional inventory is low. It only takes a small surge in selling to overwhelm the system. Now layer in the behavior of algorithms and systematic strategies. Many of these strategies are designed to respond to volatility, momentum, or correlation changes. When banks reduce liquidity and volatility rises, these systems adjust, often by reducing exposure simultaneously. That's how localized stress becomes systemic. This is not speculation. It's how markets have behaved repeatedly over decades. The triggers change, the mechanics do not. Now let's address the elephant in the room. Why now? Why would banks reduce equity exposure when economic data still looks okay, earnings are strong, and optimism remains high? Because risk is not about the present, it's about asymmetry. When prices are high, upside is limited relative to downside. When valuations are stretched, small disappointments can cause outsized reactions. When everyone is positioned the same way, exits become crowded. Banks don't need a recession to reduce risk. They just need to see that the balance of probabilities has shifted. And that shift is visible in several places at once. First, dispersion is increasing. Some stocks continue to surge while others quietly roll over. That's not healthy trend behavior. That's late cycle behavior. Second, volatility has become more reactive. Markets swing harder on less news. That tells you liquidity is thinner. Third, correlations are changing. Assets that normally move independently are starting to move together. That's a warning sign. Correlation spikes usually precede stress. Fourth, credit markets are showing subtle signs of caution. When credit becomes more selective, equity markets eventually feel it. Banks pay close attention to all of this. Retail investors usually don't, until it's too late. Now let's talk about escalation, because this is where the story becomes uncomfortable. This kind of repositioning does not resolve quietly if pressure continues. It resolves through volatility. If markets remain calm, banks will continue their slow exit. Prices may grind higher or sideways. Most people won't notice, but if volatility spikes from policy surprises, geopolitical events, macro data, or sudden risk-off behavior, the lack of institutional support becomes obvious very quickly. That's when trapdoors open. A trapdoor market looks stable until suddenly it isn't. Support levels break faster than expected. Rallies fail quickly, bounces feel weak, and people start asking why the dip isn't working anymore. It's because the buyers that used to step in are no longer there. Now, let's be clear about something. This is not a prediction of an immediate crash. Markets can stay irrational longer than most expect, but it is a warning about structure, and structure always matters more than headlines. Banks are not exiting equities because they hate stocks. They're exiting because they want flexibility. They want optionality. They want to be able to respond when conditions change without being forced into bad decisions. Retail investors rarely have that luxury. They are often fully invested, emotionally attached, and slow to react. That asymmetry is what creates opportunity and danger. Now let's balance risk, because this is not a one-way story. There are scenarios where equities continue higher, strong growth, supportive policy, and contained volatility could keep markets elevated longer than expected. Liquidity could re-enter. Banks could slow or pause their exit. That's possible. There are also scenarios where central banks step in aggressively if markets wobble, stabilizing conditions temporarily. That has happened before. But here's the key point. Even in those scenarios, volatility is likely to remain elevated. Markets rarely return to calm when structure shifts. The days of smooth, predictable equity rallies may be behind us for a while. So what should viewers watch? Not predictions, not targets, behavior. Watch how markets respond to bad news. If bad news no longer gets bought quickly, that's a signal. Watch how markets respond to good news. If good news fails to push prices meaningfully higher, that's another signal. Watch volatility relative to price. Rising volatility without falling prices often precedes instability. Watch sector rotation. When defensive sectors quietly outperform while headlines remain bullish, pay attention. Watch liquidity events, sudden gaps, failed rallies, sharp intraday reversals. So these are signs of thinning support. Above all, watch what institutions do, not what they say, because institutions don't talk when they're repositioning. They just move. And when they're done moving, the market usually looks very different. Stay calm. This is not about fear. It's about awareness. Share this with someone who thinks markets only go up. Subscribe if you want updates that focus on structure, not noise. Because when the floor finally gives way, the people who understood the cracks will already be standing somewhere safer. When banks quietly step away from equities, the danger is not the first red candle on the screen. The real danger is the illusion that nothing has changed. Markets rarely collapse when everyone is afraid. They fracture when people still believe they are safe. That's the phase we are in now. The surface still looks stable. Prices still recover. Headlines still sound optimistic. But underneath, the structure that used to absorb risk is thinning. And once that support weakens enough, price no longer needs a reason to fall. It just needs gravity. Most investors are trained to think in terms of direction, up or down, bull or bear. But professionals think in terms of structure. Who is providing liquidity? Who is absorbing risk? Who is forced to act? When banks reduce equity exposure, they are not making a directional call for tomorrow. They are removing themselves as shock absorbers from the system. And when shocks hit a system without shock absorbers, even small bumps can turn violent. This is why the next phase does not begin with panic. It begins with confusion, rallies that don't feel right, pullbacks that go a little deeper than expected, breakouts that fail quietly instead of exploding higher. Investors don't sell at first. They hesitate. They rationalize. They wait for the familiar bounce that has saved them so many times before. But when that bounce comes weaker, slower, and narrower, confidence erodes. Not all at once, one trade at a time. What breaks first is not the market. It's behavior. Dip buying stops working consistently. Volatility becomes less predictable. Moves feel sharper, faster, less forgiving. This is not random. This is what happens when liquidity retreats. In a liquid market, mistakes are forgiven, and in a liquid one, they are punished immediately. Banks understand this environment better than anyone because they help create it. They see where leverage is concentrated. They see how much exposure is built on assumptions of stability. And when they step back, those assumptions begin to crack. Volatility strategies start adjusting. Risk parity models rebalance. Option dealers hedge more aggressively. None of this requires fear. It only requires math. As volatility rises, even slightly, systems that depend on calm conditions are forced to reduce exposure. That reduction creates selling pressure. That selling pressure raises volatility further. And once that loop begins, it feeds on itself. This is how orderly markets become unstable without a single dramatic headline. Options markets amplify this effect. Years of low volatility have encouraged massive option positioning that assumes range-bound behavior. When price moves outside those expectations, hedging flows accelerate. Dealers are forced to buy or sell underlying shares quickly, adding fuel to moves that already lack liquidity. What looks like chaos to the public is simply mechanics colliding with thin order books. This is where forced selling enters the picture. Forced selling does not ask permission. It does not care about fundamentals or long-term outlooks. It sells because it must. Margin requirements, risk limits, regulatory thresholds, portfolio mandates. These triggers don't wait for confirmation. They execute automatically. And when multiple systems are forced to act at once, price overshoots in both directions. Contagion follows naturally. Equity volatility spills into credit. Credit stress tightens funding. Tight funding reduces risk appetite. Reduced risk appetite pressures equities again. This is not a theory. It is a loop that has repeated throughout modern financial history. Banks don't wait for this loop to complete before acting. They step aside early, while exits are still orderly. Retail investors usually encounter this process late, when it becomes visible. By then, correlations rise. Diversification fails. Assets that once moved independently begin moving together. Losses cluster. Portfolios that looked balanced suddenly aren't. This is why diversification feels strongest right before it stops working. And yet the market rarely moves straight down. After banks step back, there are often powerful rallies. These rallies are convincing, they restore confidence, they draw people back in. But structurally, they are weaker. They are driven by momentum, short covering, and hope rather than deep institutional commitment. These rallies are traps not because prices rise, but because support underneath them is missing. Professionals watch the quality of these moves closely. Strong markets rebound with broad participation in improving volume. Fragile markets rebound narrowly, quietly, and without conviction. When banks are no longer supporting the tape, rallies tend to exhaust faster. That exhaustion is subtle at first, then obvious, then costly. This is why the situation does not resolve quietly. Risk that has been mispriced must be repriced. Liquidity that has been withdrawn cannot be replaced instantly. Markets either adjust slowly through grinding volatility or suddenly through sharp dislocations. What determines the path is confidence in the structure. And right now, that confidence is eroding beneath the surface. None of this means a collapse is guaranteed. Policy can intervene, liquidity can be injected, narratives can shift, markets can remain elevated longer than logic suggests. But even in those scenarios, the character of the market changes. It becomes less forgiving, more violent, more selective. Complacency becomes expensive. This is the environment banks are preparing for, not panic, not headlines, structure. They are not predicting disaster. They are removing themselves from being the last line of defense, and that should matter to anyone still assuming the floor is solid. The chair hasn't broken yet, but weight is shifting, and when the final leg gives way, it won't ask whether you were ready. If this breakdown helped you see the market more clearly, share it with someone who still thinks price tells the whole story. Stay calm, watch the structure, and don't let volatility force emotional decisions. These shifts don't announce themselves. They reveal who was paying attention. Subscribe for ongoing updates as this situation develops, because in markets like this, clarity is the real edge.